Look, most traders lose money for one very simple reason. They chase breakouts. You know the feeling. You see this massive green candle printing, and you just feel like you absolutely have to jump in. But here is the hard reality check. The market rarely, if ever, moves in a straight line. Welcome to this explainer on mastering pullback strategies for high probability trading. If you're completely fed up with entering a trade right as the market suddenly reverses on you, well, you're exactly in the right place today.
Here is our roadmap for this explainer. First, an introduction to pullbacks. Then, valid versus invalid pullbacks, key market reversal levels, the BFF strategy framework, pullback probability types, and finally, entry and execution methods.
All right, let's dive right in with Section 1, Introduction to Pullbacks.
So why do most traders bleed capital? It's a painful question, right? But the answer is incredibly straightforward. They buy at the absolute top because FOMO takes over, hoping a breakout will just keep going forever. But what if you had an alternative? What if you could actually buy into that same strong trend, but with significantly lower risk? That is the absolute magic of trading pullbacks.
Think of a strongly trending market exactly like a car on a long road trip. Honestly, it doesn't matter how fast that car is going. Eventually, it's going to run out of gas. It literally has to stop at a station to refuel. In trading, that refueling process is a pullback. It's just a temporary reversal, a brief pause moving against the prevailing trend. By being patient and waiting for these dips, you get a phenomenally better risk-to-reward ratio. You're basically letting the market gather more fuel before it starts its next major leg up.
But here is the tricky part, which brings us to Section 2, valid versus invalid pullbacks. You absolutely need strict, non-negotiable rules to know if a pullback is actually real before you risk a single dollar of your capital. Let's look at the difference. In an uptrend, if price is just printing consecutive bullish candles and every single low is higher than the last one, you don't have a pullback yet. That's just a single, invalid, impulsive move. To get a valid pullback, a subsequent candle has to completely break below the lowest point of the previous candle, or at the very least, it needs to vigorously sweep its liquidity. It literally has to take out that previous low to count as a genuine pause in the market structure.
Now, when you apply this exact same rule to a downtrend, meaning you wait patiently for a candle to break above the preceding bearish candle's high, you unlock something huge. You can now recognize authentic order blocks. Getting this right helps you completely sidestep those brutal market traps where fake pullbacks trick retail traders into jumping in way too early.
Okay, so you know what a real pullback looks like. That brings us to Section 3, key market reversal levels.
Remember our car refueling analogy? Well, the market has three main gas stations where it absolutely loves to stop. First up, previous resistance turns support. This is when price comes back to retest the swing high it just broke out of. Second, trend lines. Prices frequently reject diagonal trend lines multiple times during a healthy trend. And third, moving averages. The 50-period EMA is a massive, widely respected level, and the 20-period EMA, that one is fantastic for catching shallower, really aggressive pullbacks in strong trends.
Now here's where it gets really fun. When these key levels intersect right at the exact same price point, you get an area of high confluence. Imagine a pullback dropping perfectly into a 50-period moving average that is also sitting right on a previous resistance turn support line. That intersection drastically improves your odds of a successful setup. You aren't just relying on one signal anymore. You've got multiple market dynamics all agreeing at the exact same time.
Which transitions us perfectly into Section 4, the BFF strategy framework.
BFF. This is a super actionable step-by-step playbook to categorize the specific setups you're going to see on the charts every single day. Step 1 is the B for break and retest. Step 2 is the F for first pullback. And Step 3 is the final F for false break.
Let's break them down. First, the break and retest. Price breaks confidently through a key level and comes right back to test it. But wait, here is the catch. You cannot just blindly buy when it touches the line. You have to wait for a clear bullish price rejection. We're talking about spotting a hammer candle with a nice long lower wick or a strong bullish engulfing candle right at that level. That visual rejection is your confirmed trigger.
Next is the first pullback. Look, right after a massive breakout, the market is often so incredibly strong that price just won't drop all the way back to your ideal retest level. It just hovers in a tight range. So what do? You wait for the 20-period EMA to slowly catch up to the price. The second the low of a candle finally touches that 20 EMA, you place your entry right on a breakout above that local swing high. It's a brilliant way to get on board a trend that feels like it's running away without you.
And the final piece is the false break. Sometimes a pullback goes way deeper than anyone expects, wiping out standard stop losses. The price deliberately sweeps the liquidity sitting right below the nearest swing low. But if it fails to stay down there and immediately reverses back up, that false break is a giant flashing sign signaling a massive move. The smart money just grabbed the liquidity they needed, and now it's time for you to ride along with them.
All right, let's move into Section 5, Pullback Probability Types. Because, and this is an absolutely crucial point, not all pullbacks are created equal. You need to know how to judge the quality of a setup instantly. We've got 3 probability tiers. First, fast pullbacks. These crash down with huge momentum and big red candles. Honestly, these are usually low probability traps designed to rapidly sweep retail traders out. Be super careful with these. Next, slow pullbacks. These are grinding, corrective moves with small candles. They visually prove counter-trend momentum is weak, making them very solid, medium to high probability setups. Finally, the holy grail, liquidity sweeps. These are Tier 1 setups. This happens when the market dips just enough to trigger a false breakout, sweeps retail stops to grab fuel for the institutions, and then violently reverses in your intended direction.
Okay, final piece of the puzzle. Section 6, Entry and Execution Methods.
So you've found a valid, high-probability pullback at a key level. How do you actually pull the trigger? You've generally got 2 distinct execution styles. The aggressive entry is immediate. You jump in the very second the price liquidates the previous lows or perfectly touches your demand zone. Zero hesitation. The conservative entry, on the other hand, requires a bit of tactical patience. You don't jump in right at the zone. Instead, you zoom into a lower time frame and wait for a definitive market structure shift to happen first.
Let's clarify that conservative entry really quick because it is so important. Waiting for the internal structure to shift bullish before entering means you are letting the pullback totally finish its business. You're making the market actually prove to you that the localized downtrend is dead by breaking a previous internal high. You only execute after the market tips its hand. It takes discipline, sure, but it absolutely saves you from trying to catch a falling knife.
Which brings us to our final, powerful thought for this explainer. Stop chasing the market. Let the market come to you. If you can master the patience to wait for valid pullbacks, respect those key confluence levels, and systematically use the BFF framework, you're going to completely transform how you trade. Stop buying the absolute top. Let the market run out of gas, let it refuel, and then get on board for the real ride. Before your next trade, ask yourself, are you driving the trend, or are you just providing the fuel for someone else's? Thanks for watching this explainer. Now go out there and trade smart.